Welcome back to the TD Ameritrade Network. I'm Ben Lichtenstein. Today we're looking back at the year that was in futures markets. The primary focus will be on commodities, but we'll also discuss the impact low interest rates and a strong U.S. dollar had on gold, crude oil, beans, wheat, and corn. It was a volatile year for commodities. Grains were on the move earlier in the year as cold weather and heavy rainfall impacted planting. Energy products faced demand concerns tied to U.S.-China trade talks and slowing global economic conditions. For metals, gold traded to six-year highs as rates fell in response to a dovish Fed. Throughout all this, the U.S. dollar remained strong on multi-year highs. Bid as weakness in the euro and the British pound tied to Brexit buoyed the greenback. It was another wild year for futures. Let's begin our look back today into the energy space. I'm joined by Ashley Peterson, the senior oil analyst at Stratus Advisors, and Matt Smith, the director of commodity research at Clipper Data. Welcome to the TD Ameritrade Network Year in Review. Ashley and Matt, really appreciate you joining us here to look back at the year that was. Ashley, the fourth quarter of 2018, we saw WTI crude fall to $42 a barrel on demand concerns. We rallied back this year into mid-April, but the concerns remained even as U.S.-China trade talk negotiations progress. Can you talk to us a little bit about how this price was primarily driven by the demand side of the discussion this year?
Yeah, so we saw these prices fall at the end of 2018, and clearly demand was a concern the whole year in 2019 because we never got the rally that we did in 2018. Obviously, traders and markets are very concerned that consumer spending and consumer transportation are going to start to slow, similar to the pattern we saw in manufacturing and industrials throughout the course of the year. But interesting, though, is the U.S., even despite the price weakness, has actually been one of the stronger markets. We have more balanced fundamentals, and our economic indicators have been more robust than in Europe and some parts of Asia.
Yeah, you talked about in your notes how this actually forced companies to maintain capital discipline, and it didn't really provide any outside hedging opportunities for them.
Yeah, companies didn't get that third quarter opportunity that they did in 2018 to hedge the future production, which is just another way that we're going to see lower production growth into 2020. It'll certainly help keep balances less sloppy, but will it be enough to overcome these persistent demand concerns is the question.
Matt, let's talk about how demand was the focus, certainly when it comes to trade and global economic concerns. Matt, was it partially due to the fact that we were so well supplied? I mean, we had shale, we had OPEC, and even strategic petroleum reserves that were released. Supply certainly wasn't an issue. The well-supplied market and the strong U.S. dollar provided crude with a bit of a headwind this year.
Yeah, very much, Ben. It felt like that. You know, we had this OPEC production cut deal redux, beginning 2019 here. But we again saw Saudi Arabia leading the charge there. But at the same time, we saw sanctions being placed on Venezuela in late January. We've seen Iran being crimped back in terms of their exports as well. All the while, though, you just weren't seeing a price reaction, and that just really spoke to the fact that the market was really well supplied there, and OPEC really needed to dial back even further to try and lift prices. And as we've seen, they weren't really able to do so. At the same time as well, as we kind of got to the mid-year period, that was when these demand concerns really started to kick in. We're seeing it showing up in the economic data. And then the trade war concerns as well then further juiced that. And so it has been those two elements there which have helped prices remain pretty much within a range here for WTI between 50 and 60 for the second half of the year, pretty much. And for Brent, sort of $5 higher than that, 55 to 65. So a fairly range-bound market for the second half of the year.
Yeah, Matt, sticking with production for another minute, this fall, OPEC said they expect supply to diminish over the next 5 years to 32.8 million barrels per day. It's currently around 35 million barrels per day. In doing so, did OPEC succumb to U.S. shale producers? Did OPEC just cry mercy?
Well, yeah, to a certain extent they have, and they're going to have to going forwards as well. We've got non-OPEC production continuing to look strong into next year, not just with the US. Obviously, U.S. production growth is slowing. We'll see that coming through in 2020, but we've just had a new field come online in Norway. We've got Brazilian production growth continuing there. So it isn't just a U.S. story here, but what this means is that OPEC going forward is going to have to keep their production in check if they want to keep prices buoyed.
Yeah, Ashley, that's what I wanted to ask you about in terms of OPEC keeping the production in check, because throughout the year 2019, that was a lot of attention was directed towards the December OPEC meeting and potentials for a cut there. But we were also hearing in the fall of 2019 about how if they could get some of their producers in line, in check, and again, to reduce some of the production, that this could actually act similar to or impact the market in a similar fashion that more cuts would, if we could just get compliance to where it should be.
Certainly, it would help if we could get compliance where it should be, but considering they recently had to rebase Nigeria's baseline volumes just to make the compliance numbers look better, I don't think they're going to be able to get them any more enforced. You know, perhaps you could get a little more enforcement from Russia. Saudi Arabia is doing all it can. The opportunity to get those cuts better is just not there. So we're going to have to see either volume reductions or adherence coming from somewhere else, and that's most likely to be Saudi Arabia.
Ashley, shifting back to the demand discussion, 2019 was the year of the U.S. consumer. The health and well-being of the resilience really seemed to help support the stock market. Can we look to the consumer in 2020 to help us determine demand as far as whether a bellwether for crude, I guess you could say, or should it be higher up the chain in terms of manufacturing or simply inventory levels?
So we can look to the consumer, but that's really just going to provide baseline support for demand. Growth is coming out of Asia, so we need to see Asian manufacturing and also Asian consumers stepping up their growth levels. You know, we've seen some troubling jet fuel numbers in the demand space in the latter half of this year. Is that trend going to continue? So it's a slowdown in Asian consumers that we need to worry about more than we'll get a benefit from strength in the U.S. consumer.
Matt, we've talked about demand, we've talked about U.S.-China trade. I'm wondering what are going to be some of the forces to be reckoned with in 2020? What are you going to be keeping your eye on?
Sure. OPEC, as always, really, just to see if we're going to get that continued compliance coming through from them, where they are going to make those cuts, because they are going to have to do so, it would seem. We're always looking for an end to the trade war as well, so hopefully that's going to come through next year. And so that's really the main thing from a supply and a demand side of the picture here, really. The economic data has looked so weak at times during 2019. We're going to have to see if we finally get pushed into a recession in 2020 or whether we're going to see a recovery and acceleration out of that.
Ashley, we're going to dive a little bit deeper into currencies and the year that was in terms of the U.S. dollar, but can you speak to us a little bit about the strength we saw in the greenback and how low rates had an impact on crude in 2019?
Yeah, so low rates certainly helped. Strength in the dollar typically leads to a bit of weakness in oil, although you tend to see that in a fully balanced market, more so than one with a little bit of oversupply. So I think the translation hasn't been as strong this year as we would have expected. Given our expectations for slowing U.S. growth and strong non-OPEC growth, but OPEC compliance and fairly resilient demand, I think the dollar could actually be even more critical next year in 2020.
Ashley, any geopolitical concerns that you have headed into the new year?
Always. I actually think that's going to be, if I had to add on to Matt's list, something we should really watch next year. We finally saw geopolitical activity and a bit of a brief price premium this year. I think the chances of unrest continuing and perhaps expanding next year, seeing more activity in Libya and Nigeria and a little more activity in South America, especially causing disruptions, is a pretty high likelihood heading into 2020, which could be supportive for prices given the more balanced market we're expecting.
Matt, can you talk to us a little bit about some of the changes to come? There's a lot of talk of potential impact for that the more stringent maritime requirements could have on crude oil and price activity. I've heard it equated to the Clean Air Act when lead was basically banned from gasoline.
Yeah, so with IMO 2020 is the biggest impact in the global market, really, that we've had for a number of decades. But that impact has been tempered somewhat. You know, at the beginning of 2019, we were expecting to have this cataclysmic impact And yet, because the economy has slowed, we're not seeing as much of an impact through that side of things. That said, we're still looking for about 1.5 million barrels a day of incremental demand coming through for middle distillates. And so this is going to have an impact as we move through 2020. It's encouraging these refiners to refine more. And so there is a bit of support from the crude side of things there as that demand is encouraged. And so that said, as we get through the sort of the first half of 2020, things are going to settle down there. And then we'll have to see where we go from there. But yeah, it's going to have a real impact. And the interesting thing is no one really knows exactly what that is going to be until it actually happens on the 1st of January.
Yeah, certainly something for us to watch. And in addition to the other topics that we've covered, really appreciate you two joining us. Ashley, Matt, great to have you with us here on the Year in Review and our look back at 2019 in energies. Traders, that's Ashley Peterson, the Senior Oil Analyst at Stratus Advisors, and Matt Smith, the Director of Commodity Research at Clipper Data. Coming up, a discussion on how historically low rates impacted markets in 2019. The TD Ameritrade Network Futures Year in Review continues after this short break.
You've had quite the career.
Yeah, I've had some pretty prestigious jobs over the years. News producer, executive transport manager, and a beverage distribution supervisor. Now I'm a director at a security software firm.
Wow, you've been at it a long time.
The thing is, I like working. What if my retirement plan is I don't want to retire?
Then let's not create a retirement plan. Let's create a plan for what's next.
I like that.
Get a plan that's right for you. TD Ameritrade.
Attention Apple users, there's a new way to watch.
Download the TD Ameritrade Network iOS app.
You can watch us live or create your own video on-demand playlists to catch up later.
Download the TD Ameritrade Network iOS app, available in the App Store now.
Turn on my TV and boom, it's got all my favorite shows right there. I wish my trading platform worked like that.
Well, have you tried Thinkorswim? This is totally customizable, so you focus only on what you want.
Okay, it's got screeners and watch lists.
You can even see how your predictions might affect the value of the stocks you're interested in.
Now this is what I'm talking about.
Yeah, it'll free up more time for your true crime shows.
British baking competitions.
Didn't peg you for a crumpet guy.
Focus on what matters to you with Thinkorswim.
I'm Nicole Petalides, coming to you live from the NASDAQ every single day from the opening to closing bell. Tune in to TD Ameritrade Network.
Welcome back. When talking futures and looking back at the year of 2019, it would be a big mistake if we didn't mention the huge role treasuries, that's futures and rates as in yields, had on the markets. The Fed's sudden shift from a hawkish stance to a dovish tone amidst trade war concerns and global economic uncertainty sent treasury futures trending higher. The 30-year yields to record lows and briefly inverted the yield curve. To help me discuss the impact treasuries had on markets this year is Scott Kimball, Director and Portfolio Manager at BMO Global Asset Management. Welcome to the TD Ameritrade Network, Scott, and thanks for joining us for the Year in Review. Let's begin with the Fed's sudden shift from hawkish to dovish and how it was a primary driving force this year as it seemed the trading community was caught off guard.
Certainly, I think if we go back to the beginning of the year, we think about the policy the Fed was looking to implement and how it unfolded. The Fed came in probably in a very traditional stance, thinking that U.S. economic data in isolation looked very good, or at least reasonably good for the length that we're into this recovery, and had to make a decision about monetary policy going forward. And a few things complicated that picture. So I'll actually start off and talk about the yield curve, and particularly the inverted yield curve, to kind of set a baseline for the rest of our thoughts. The first is that a yield curve is telling us what the bond market's future projected path for an economy really is. So when we start talking about inverted yield curves, what the inverted yield curve is signaling is that the market expectations going forward are for a declining growth environment. So the Fed looked at that as a signal and said, well, if the data looks good and we're 70% domestic consumption in the U.S., what's the challenge here? What is the market having a hard time with? And the reality is that even though we may be 70% operating on our own inertia, they look overseas and see that the trade headlines, for example, while maybe not directly related to what we think about the U.S. economy as an engine, it certainly was a big factor for markets. And markets were looking at the disruption that trade-related headlines are causing, and as those oscillate between both positive and negative trajectories, the Fed was thinking, what do we have to do in order to adjust for that? So the shift was to move from a more hawkish stance to a more dovish one, begin using the term a mid-cycle adjustment, if you will, as what the Fed categorized it as, to take some of the pressure that trade headlines were having off of markets. The second factor, which is probably equally important in this, is the situation in Europe. We talk about the U.S. data looks okay in and of itself, for where we are in this recovery, but the data in Europe has not looked fantastic. And we continue to see that the ECB is having to inject stimulus into the system and the growth continues to decline. So the Fed likely entered a stance where to avoid having the slowdown in Europe make its way into the U.S. economy, they lowered rates to normalize the interest rate differential between what's going on from the U.S. Fed fund standpoint and overseas.
Scott, you mentioned the rate differential in terms of the situation that was developing this year with Europe as negative rates were significantly impacted the euro currency. We saw the Brexit negotiations impacting the British pound, all for the most part weighing on the currency, which helped lift the U.S. dollar and also created the scenario where we saw a little bit of a disconnect between rates and the U.S. dollar here in the U.S. Throughout 2019, for the most part, rates were falling, yet we saw a dollar which was strong and holding near highs.
Yeah, the dollar is going to be a challenge we talk about the Fed, principally, but also for investors. The dollar is going to continue to be a challenge because as long as interest rates are higher in the U.S., which we think is going to continue, it's going to continue to attract money into the dollar-based funding market. That means support for U.S. Treasuries, support for corporate bonds, support for U.S. dollar-denominated assets in general. So our view is we continue to structure into next year looking for a strong dollar. We don't think that the Fed or really any measure of policy is going to be able to take any pressure, the upward pressure off of the dollar.
Scott, in your notes, you mentioned how U.S. interest rates, the market remains a global perspective. I'm wondering if you expect this to continue in 2020.
Yeah, certainly. We think if anyone's learned the global perspective of the rate market this year, it's probably the Fed. When you think about the U.S. yield curve, if you look at the trajectory that we were seeing when we had the inversions, yes, the inversions have gone away, but we're still flat. Mm-hmm. So what is that telling us? It doesn't reconcile with the U.S. data. So the pieces that we think in the equation that signal why the U.S. yield curve is being so stubborn, despite what seems to be a very resilient growth story, it continues to be the global perspective. I take a cue from some of my colleagues in BMO on the equity side, is if you look at the 28,000 plus, we've been sitting at the Dow, for example, relative to what's a very flat trajectory for the U.S. yield curve. It's a bit of a disconnect. Certainly low rates can lead to higher valuations in all risk markets, corporate bonds, high yield, equity, real estate, et cetera. But you would think there'd be some steepness to the U.S. term structure, meaning higher long-term rates at least, given this strong outlook that risk has. Yeah. But instead, the U.S. yield curve is being stubbornly flat. And we think that, again, goes to the global perspective where foreign buyers are just pouring into the U.S. market because this is where the yield is. We think about U.S. rates in isolation. 1 3/4 10-year Treasury may not get us excited domestically, but if you're sitting in Germany at negative 0.5%, that's a positive 2.25% yield. So as long as that dynamic exists, there's going to continue to be global flow of funds into the U.S.
Let's talk about, you brought into the discussion the indices there, the equities, and the rally that we saw this year, mostly fueled by lower rates. It seemed like certainly an appetite for them. Is that necessary to see the continuation? Do we need to see rates lower, continue lower, I should say, in 2020 in order to fuel the stock market higher?
It's tough to tell. I believe that there's two things that are pushing risk in general. When we talk about risk, we talk about stocks as well as corporate bonds and yield. The factors that are probably pushing that or driving that, low rates are certainly going to be a portion. But a secondary factor is probably just the fact that the U.S. recovery continues to chug along more than people are expecting. So as the economy goes, so goes risk. Rates are a component of that, but we think the growth outlook continuing to be on firm footing is likely to really press the story even further than rates.
Scott, you briefly touched on the yield curve inverting this year, briefly inverting, I should say. I'm curious because it created quite the stir, to say the least. As many said, it signaled a recession to come. You mentioned how it signaled declining growth. I'm wondering, was it different this time because rates are at significantly lower levels than we've seen in past yield curve inversions? And I wonder if it sets this situation a little bit differently and aside from some of the past scenarios that we've seen develop.
Yeah, great question. And I think, inverted yield curves are the proverbial boogeyman of the bond market. Mm-hmm. That's usually the signal that many interpret as saying the party is over somewhere. We just have to decide where, if not everywhere. So the thing to keep in mind is that the batting average of the yield curve inversion, it's a bit of a murky or mythical indicator, if you will, in that, yes, it has preceded all U.S. recessions. However, not all inverted yield curves have led to U.S. recession. So they do exist at times where growth continues. That was our base case for this one. We think what it was seeping in was that it was really the market screaming for the Fed to normalize policy relative to the rest of the globe. Now that the Fed has cut interest rates and the interest rate differential between the Fed and ECB has narrowed pretty significantly, the market has calmed down. And you've seen that there's been a bit of a normalization. The curve is still very flat, but we're past the inversions, which means that the growth trajectory going forward is likely pretty low, but still pretty reasonable.
Scott, really appreciate you joining us here for our look back at the year, the 2019 year in review, and treasuries, the impact that low rates had on the market across the board. Traders, that's Scott Kimball, the Director, Portfolio Manager at BMO Global Asset Management. That's a look at the year in review. Traders, we're going to take a quick break. When we come back, Marc Chandler, the Chief Market Strategist at Bannockburn, joins us to discuss the strong U.S. dollar, Brexit negotiations weakening, Eurozone economic data, and the impact this all had on currencies in 2019. Our year in review continues after this.
What do you look for when you trade?
I want free access to research.
Yep, TD Ameritrade's got that.
Free access to every platform.
Yeah, that too.
I want to know what I'm paying up front.
Yes, absolutely.
Now offering 0 commissions on online trades.
To be ready for what's next, you gotta know what happened.
I talk about the banks. I want to just hit it hard. The traders are betting no rate hike.
Join me, Oliver Rennick, as we take you through the final bell with the stories, trades, and charts behind the market action.
So rates are coming down. Did great because they were pinching pennies.
Exclusive content for cord-cutting investors, because no one does markets like we do.
Can't lie about cash flow.
Market on Close, weekdays 3 p.m. Eastern, 2 p.m. Central, only on the TD Ameritrade Network.
You've had quite the career.
I like working. What if my retirement plan is I don't want to retire?
Then let's not create a retirement plan. Let's create a plan for what's next.
I like that.
Get a plan that's right for you. TD Ameritrade.
Okay, paint a picture for me.
This will be the kitchen.
Yeah, and we'd like to put a fire pit out there and a dock with a boat, maybe.
Why haven't you started building?
Well, Tyler's off to college.
And Mom's getting older.
And eventually we would like to retire.
Yeah, it's a lot, but TD Ameritrade can help you build a plan for today and tomorrow.
Great. Can you help us pour the foundation too?
I think you want a house near the lake, not in it.
Come with a goal, leave with a plan. TD Ameritrade.
It's a beautiful piece of land, so why haven't you started building?
Tyler's off to college.
Yeah, and Mom's getting older.
And eventually we would like to retire.
TD Ameritrade can help you build a plan for today and tomorrow.
Come with a goal, leave with a plan. TD Ameritrade.
Welcome back. We just took a look at the role Treasuries played on markets in 2019, but the interest rates were only half the story when talking the year in financial markets, because the US dollar also had a major influence on commodities, the indices, and multiple closely watched markets. Ladies and gentlemen, I'm happy to say we have Marc Chandler, the Chief Market Strategist at Bannockburn, here for a look at the year in currencies. Marc, welcome and thanks for sharing part of your day. Let's begin with a big part of what buoyed the US dollar this year, and that was a weak euro currency and a weak British pound as Brexit concerns, US-EU trade negotiations, and weakening eco data took its toll on the euro and the pound.
Yeah, no, I think you're right that the 2019 was really more of a story of weakness abroad than it was about strength in the U.S. As you know, the Federal Reserve cut interest rates 3 times over the course of the year, which is more than the ECB cut. And of course, the Bank of England's been on hold given this Brexit developments.
Marc, you mentioned the Federal Reserve. I wanted to ask you a little bit about the dollar disconnect from rates that we saw throughout 2019. Earlier in the show, we actually took a look at how they spent the bulk of the year trending lower, rates that is, yet the dollar was trending higher. This coincided with a shift in central bank policy, the Fed, ECB, People's Bank of China, and others as a driving force this year in terms of the greenback.
Yeah, so I think that what's really going on here is that the relationship between interest rates and the dollar is much more complex than the linear type of view. I think it's sort of cyclical, whereby the last phase of a dollar's rally takes place when those interest rate differentials are actually moving against it. It is as if people say we don't need such a return on U.S. assets because we have the dollar at our back. And I think, in my mind, this is still consistent with this last phase of a 10-year bull market for the U.S. dollar.
So let's talk a little bit about how the focus has been on U.S.-China trade, because the yuan actually came under the microscope again, so to say, back in the first week of August, I think it was. The U.S. went ahead and moved forward, labeling China as a currency manipulator after the yuan dipped below key support. Now, these were harsh words, Marc, but it seemed to have little impact. Was that because the Chinese acted so swiftly to return the yuan back to acceptable levels? And have we kept, well, the fact that they've been able to keep it above key levels since, for the most part?
Yeah, so I think that the Chinese, when the news first broke that the U.S. was going to put more tariffs on China, that meant that the Chinese economy was going to slow down. And so I think that that was seen as by the market as a reason to press the RMB lower. And then when China stood away from it, allowed this to happen. Mm-hmm. The dollar RMB currency is highly managed. And we watched the fixing very closely, how the Chinese set their reference rate by which they let the dollar move in about a 2% band, which it hardly ever really explores. So I think that the Chinese, by not having a maximum devaluation, by letting the dollar not just go skyrocketing through the 7.0, but actually hugging it very closely. When everything's said and done, at its worst case, the RMB was down about 2.5% to 3% against the dollar this year, which is quite minor compared to the other major currencies.
Marc, let's talk a little bit about the impact of negative rates in terms of the impact that it's had on the euro currency, but also the impact that you've seen on the euro economy in general.
Yeah, isn't it? It's really an amazing thing. What we're going to learn here at the very end of 2019 is that the German economy, the biggest Eurozone economy, the fourth biggest economy in the world, looked like it contracted for 2 consecutive quarters despite negative interest rates. It's really a remarkable thing, first just having negative interest rates in the first place. I think sort of what they maybe you'd say, okay, boomer, that we do have negative interest rates. And this itself is really a mind-boggling thing. We always thought that the zero was the bound. And I think that this experiment with negative interest rates hasn't really proven itself yet. That is, countries that have adopted negative interest rates haven't figured a way to get out of it quite yet. But on the other hand, it really influences the cost of hedging. For example, the latest data from the Ministry of Finance in Japan shows that the Japanese themselves were huge buyers of European bonds, more so than treasuries, at the beginning of their second half of their fiscal year in October, because the cost of hedging, when you sort of like incorporate the cost of hedging for European bonds for Japanese investors, it actually gave a better return than U.S. Treasuries. So what I would caution you about is that thinking about negative interest rates, of course, the holder of the bonds get capital gains. They don't really get a yield per se. But for foreign investors, it skews the incentive structure for hedging. And those negative yielding bonds can actually produce a positive yield when you hedge out the currency.
Mark, you mentioned how they haven't managed to find or figure a way out of that negative interest rate environment. I'm wondering, because many argue that fiscal stimulus could help. And I guess when you look to countries like Germany, Norway, countries that actually have the ability to, you should want to lean on them. But we heard in the fall of 2019, I think it was from the EU Commission, they said basically that the EU, they didn't expect to see Norway or Germany actually take that next step.
Yeah, that's kind of a problem, right? Is that, here in the U.S., we're the world's largest debtor. And the UK, Australia, Canada, these countries also are debtors. And we as debtors are trying to convince the surplus countries, those with savings, that they should take on more debt. It's sort of like that old Aesop's fable about the grasshopper and the ant. But I think it also goes to this idea that there's not just one capitalism. The kind of capitalism that they practice in Northern Europe, we call it ordoliberalism. And it really doesn't see room for the Keynesian counter-cyclical stimulus. Or if they do see the need, it's got to come from a much worse economy. And so I think that those skeptics are right that we shouldn't expect large fiscal stimulus from the large savers in Europe.
Mark, this wave of central bank dovishness is not just the FOMC. We've talked about multiple others that have been participating. Where do we go from here? What should we expect to see in 2020? More of the same?
Yeah, so I'm in the camp that says the Federal Reserve's mid-course correction was always meant to be about 3 rate cuts. But I think that mid-course correction is going to have to be more than just that. I think that with the U.S. recovery in 2019, 10 years old, the longest on record. Mm-hmm. And so I'm worried that the economy is still rolling over. And that whether it's jobs, auto sales, the U.S. consumer, different measures of the stress coming to the U.S. consumer, see this on credit card delinquencies and the like. I'm concerned that the Federal Reserve will have to cut rates again, maybe twice before the U.S. election, before we get too close to the U.S. election in November. That to me is a real concern. And I think the U.S. will be more aggressive than the ECB or the Bank of Japan. And I think both of those central banks will have to cut rates again. And I don't think we're done with the Bank of China yet either, the People's Bank of China. They gave us a very small cut in late 2019, 5 basis points or so. And it does look like the financial conditions are tightening up in China. Deflation rather than inflation, I think, remains the biggest threat as we head into 2020.
Yeah, well, at the top of the interview, you mentioned some of the concerns you had in terms of the dollar being able to sustain these upper levels. Maybe lower rates would add to some of that or weigh on the U.S. dollar. Mark, really appreciate you joining us. A great discussion here. Look back at the currency markets, the year that was. Traders, that's Marc Chandler, the Chief Market Strategist at Bannockburn. We're going to take a quick break, but coming up, we're looking at the year that was in metals. That's gold, silver, copper. So stay right here on the TD Ameritrade Network. The year in review. We'll be right back.
Got any weekend plans? We've got you covered.
This is one people I think are going to be watching really closely.
If you missed this week's action, Pat, walk me through some of the numbers here, pal.
That's what a lot of investors are asking themselves now.
Weekend Trader gets you caught up and ready for what's ahead.
That we call a sign of strength.
Hottest market trends. Such an interesting stock because it's been in such a tight range. Biggest earnings. What should people be concerned about? Charts of the week.
This is a stock certainly that can generate some short-term momentum.
5 p.m. Eastern Fridays and all weekend long only on the TD Ameritrade Network.
I'm Nicole Petalides, and there's only one place making sense of the markets in a way that matters to your investments. No politics, no noise. From bell to bell and beyond, tune in to TD Ameritrade Network.
I'm happy to give you the tour. I love doing it. Hey, Jay.
Jay? Charlotte.
Oh, hi.
He helped me set up my watch list.
Oh, he's terrific. Excellent tennis player.
Bye-bye. I recognize that voice. Annie? Yeah. She helped me find the right bonds for my income strategy.
Very popular around here. There's a birthday going on.
Carl, he took care of my 401k rollover.
Wow, you call a lot.
Yeah, well, it's my money we're talking about here. Joining us for karaoke later?
I'd love to, but people get really emotional when I sing.
Help from a team that will exceed your expectations.
Turn on my TV and boom, it's got all my favorite shows. I wish my trading platform worked like that.
Have you tried Thinkorswim? This is totally customizable.
Now, this is what I'm talking about. Focus on what matters to you with Thinkorswim.
For investors, confidence is key. And the key to gaining confidence is watching your first trade. I'm Scott Connor, here to make sense of today's market news in real time. Let's just jump right into the 4 major indices, get a quick check on what the markets are doing, and take you step by step through investment and trading strategies.
At what point have we kind of capped out our maximum loss with buying this call to protect us?
Your first trade, airing live Monday through Friday at noon Eastern, only on the TD Ameritrade Network.
Welcome back to the Year in Review. We're talking futures in 2019. Before the break, we had a look at the U.S. dollar and the greenback's trend up we saw throughout most of 2019. This would normally provide a headwind for commodities like gold, but with rates headed south and U.S.-China trade unknowns, gold was a bit of an outlier, rallying back to 6-year highs this summer as geopolitical unease provided a soft landing to any significant sell pressure. I'd like to bring in our guest. Everett Millman is a metals specialist. He joins us from Gainesville Coins and is here to help us break down the year in metals. Everett, it's good to have you with us. Let's begin with gold and how it was supported by low rates. Many would argue the indices and stocks need low rates to hold upper levels into the end of the year. How about gold? Are low rates essential for it to remain or retain its luster?
I don't think essential, Ben. I mean, the low rate environment really made a winner out of almost everything. Gold responded most acutely to just the general macroeconomic conditions and the fact that we just had a slowdown in global growth and the fact that it kind of trumped the natural seasonality that we see with gold. Under normal circumstances, most years, the seasonal factors do produce this reliable inverse head and shoulders pattern with the gold price, where in the early months in the year, in the winter months, and at the end of the year, we tend to see gold prices rise, and then there is the summer doldrums, the slump in the middle. 2019 really saw the inverse of that. It was the complete opposite, where the summer months were when gold rallied the most, and that is mainly because of the lack of any conviction with the global economy growing and the rise of recession fears that really did drive global markets, and it was reflected in the gold price. I think when we look back on 2019, that will be the defining feature, even more so than the low interest rates that you mentioned at the top.
Noted, and it was interesting because even with gold rallying, to see an industrial metal like silver lead at times, I mean, it seemed to lead gold at times to the upside, like back in September when it traded back to just shy of that $19 level, but gold, silver, the ratio remained at historically high levels throughout the year. Were you surprised to see this spread remain at historically high levels and to see it remain at these levels as long as it has, Everett?
Absolutely. I mean, it seems like inevitable that ratio would correct backwards. But it is interesting that silver not only followed the trend with the gold price, but it did it at sort of an amplified level. Yeah. It was the more volatile of the two metals, and it did see a wider trading range, around 1440 in the lows during the spring, and then as high as 1950, as you said, at the September high. That was equal to the top and bottom of the 5-year range for silver. So that was one of the main themes for silver in 2019, was this continued volatility and this wider trading range, greater than gold, but kind of following the same trend, the same pattern set in front of it by the gold market.
Everett, sticking with and speaking of industrial metals, one of the geopolitical factors impacting metals this year, 2019, was trade. Can you talk to us a little bit about the impact U.S.-China trade had on copper?
That was definitely the main driver, was the Sino-American trade war, and it showed no signs of abating throughout the year. Copper was essentially in a continual downtrend because of how that weighed on demand. And when you consider how China has become an increasingly large proportion of the growth driver for the global economy, and that it is still the #1 consumer of copper, that tends to make sense. So that weighed on copper year round. The one countervailing force that we did see that provided some support and some stabilization for the copper price was the fact that there were these supply disruptions in some really key areas. Some major players in copper mining in Latin America and Africa saw some labor protests and some supply shortages that at one point in the year did cause a modest drawdown of the LME copper reserves, their stockpile of copper. So if not for that, I think we would have seen even lower copper prices. But as you said, the trade war was far and away the most important factor that influenced not just the copper price, but manufacturing around the world. We saw a pretty sharp decline in industrial production in other places like Germany and India, and the fact that the United States and China both did see the first signs of a contraction to their manufacturing sector basically set the stage for copper all year long.
Everett, can you talk to us a little bit about how some of the massive flows we saw this year into gold ETFs and physical gold, for that matter, and the impact that that had on futures prices? I mean, imagine that helped buoy prices as well this year.
It certainly did, especially from a sentiment standpoint. I think gold was mostly responding this year not just to the actual macroeconomic factors, but the narratives that are spun around that data and those factors. So as you said, gold ETFs saw massive inflows, their best inflows in 6 years. But most of it was central banks and large financial institutions buying. So to kind of get back to the situation that the low interest rate environment has created, a lot of central banks, knowing that rates are going to go lower, have sort of hedged against that possibility and increased gold as a part of their reserves. So that's definitely a big part of what has driven gold this year. And it would seem to be in place for the foreseeable future as well.
Yeah, well, that's what I was going to ask you about next, is the foreseeable future, because with all those inflows to the ETFs, consequently, we've seen gold at record open interest in terms of the futures. I mean, what is this telling you in terms of 2020? More to come?
More to come, and certainly just more attention on the gold trade. I think more traders will want to be on the long side of that trade because there's just so much activity in it. And it's sort of a matter of there being no other alternative. As we see crowded trades in the bond market and in foreign exchange, there really aren't many other safe havens other than gold for investors to pile into.
You know, Everett, you said there's no other alternative, and that made me think of the rally that we had seen in palladium this year. The product into new all-time highs, but there was actually talk earlier in the year how platinum could be an alternative to palladium if we saw prices get too high too fast. They certainly did rally at a rapid rate. I'm not sure if they've reached the levels that could be classified as too high, but it was interesting because platinum never really played catch-up for the most part, or never really saw that interest that we saw with palladium.
That's true. Platinum did have sort of a less interesting year compared to all the other precious metals. It had a tighter trading range. But what was fascinating is that whereas gold and silver emerged from what would be about 5 years of stagnation in prices, the platinum price saw a definitive reversal of trend. So since the global financial crisis, platinum prices have been in a pretty consistent downtrend. And in 2019, although it was very modest gains, we did see a turn toward an uptrend. So it may have benefited from some substitution effect relative to palladium, because I will have to admit and eat some humble pie here that I was surprised by how much palladium prices rallied this year. I expected, as it took out successive all-time highs, that at some point here, we would have to have a pretty violent downward correction. And I spent all year calling for that and waiting for that, and it just never materialized. So, you know, when you're wrong, you have to admit it. A lot of my other bullish calls on the precious metals did get vindicated and play out. But palladium was, it was incredible that it was not only the best performing precious metal, it didn't just beat out all other commodities. It was, in fact, the best performing future of all of 2019, and by a rather wide margin as well. So I don't think anybody really could have predicted that. I don't think that it was on a lot of people's radars, but because palladium has gotten so high, I do think that we could see that platinum-palladium ratio correct back into platinum's favor, if only because the two metals are used for such similar things on the industrial side that it just makes sense to substitute one for the other.
Yeah, when you're talking and trading markets all day, every day, Everett, you're going to be wrong every once in a while. What's key is to be able to admit it, identify it, and move on.
Right.
Everett, really appreciate you joining us here for the look back at metals, the year in review, talking 2019 with Everett Millman. He's a metal specialist at Gainesville Coins. A great discussion there. Coming up, we're going to bring in Virginia McCarthy. She's the president of McCarthy Commodities. She joins us to talk the volatile year in grains. That's beans, wheat, and corn. The futures year in review. More of our look back at 2019 continues after this.
This piece is talking to me.
Yeah? So what do you see?
I see an unbelievable opportunity. I see best-in-class platforms in education. I see award-winning service and a trade desk full of experts available to answer your toughest questions. And I see it with 0 commissions on online trades.
I like what you're seeing.
It's beautiful, isn't it?
Yeah.
TD Ameritrade now offers 0 commissions on online trades.
You've had quite the career.
Yeah, I've had some pretty prestigious jobs over the years. News producer, executive transport manager, and a beverage distribution supervisor. Now I'm a director at a security software firm.
Wow, you've been at it a long time.
The thing is, I like working. What if my retirement plan is I don't want to retire?
Then let's not create a retirement plan. Let's create a plan for what's next.
I like that.
Get a plan that's right for you. TD Ameritrade.
Attention Apple users, there's a new way to watch.
Download the TD Ameritrade Network iOS app.
You can watch us live or create your own video on-demand playlists to catch up later.
Download the TD Ameritrade Network iOS app, available in the App Store now.
Welcome back to the TD Ameritrade Network Year in Review and our look back at futures in 2019. I'm your host, Ben Lichtenstein. It was a volatile year for grains traders between cold, wet weather early in the planting season, creating headaches for farmers, and headline news related to U.S.-China trade talks. Beans, wheat, and corn were on the move in 2019. To discuss what sparked the volatility in ags this year, Virginia McCarthy, the president of McCarthy Commodities, joins us. Virginia, thanks for sharing part of your day with us here on the TD Ameritrade Network. This year, it seemed like there were 2 major factors impacting grain markets, weather and trade. First, let's talk weather. Can you walk us through some of the challenges farmers, hedgers, and speculators face this spring with the colder and wetter than normal conditions impacting planting?
Well, it wasn't just the wetter than normal conditions. It was, I haven't seen the weather like that for planting season in my career in this business in over my 40 years. It was so difficult to get the grain in the ground. And even though we've had, better seeds over the decades that have improved enormously, we were not able to really get things rolling right away. There were many farmers that had to replant their entire fields. So getting a late start, for sure, the market was, really enduring some difficulty, and we thought absolutely this was going to affect the quality and the yield numbers come the end of the season. But there were other issues that, played into the game, and it was very difficult. And of course, then every time we got a crop report, the numbers didn't really bear out exactly, and we weren't sure really until this past, until like late in October and really early November, that final report that we were able to really see what the actual numbers were. So it was a difficult summer all the way through because of the wet start, and then we had that dry spell in the middle. And then it was wet again towards the end, and we was having difficulty getting a lot of the crop out of the ground after that.
Yeah, you mentioned how in the beginning of the year, in the spring, it wasn't just the wetter conditions, because we actually had colder than normal conditions as well. And this all actually forced farmers to kind of make a decision between whether they should plant beans or corn, and that impacted price as well.
Well, it definitely did. And I have to say that I think we were really unsure about how long even the trade war was going to last. And that definitely added some difficulty and challenges to the farmers on exactly what to plant. And it always felt like, a trade deal was right around the corner. And so everyone was holding up, trying to wait until a deal was signed so that they could actually see what the numbers are going to be. So the difficulty the farmers had in getting that in the ground was very, very difficult. And I think, with the cold weather, then the wet weather, on top of the trade war, they were really enduring quite a bit.
Yeah, and Virginia, you mentioned it wasn't just the spring. This fall, we actually saw wetter, colder than normal fall conditions, and this had bean farmers, some of them, I was hearing about how they were forced to leave beans in the fields.
They were, and interestingly enough, we did get a little bit of a cold snap over a couple of weeks that were early, and some of the areas in the Dakotas welcomed it because they thought if they could at least freeze the ground a little bit, they could get their combines out on there to try to retrieve whatever they could.
Yeah. Let's talk a little bit, Virginia, about U.S.-China trade talks, tariffs, how they sparked all kinds of demand concerns that it seems as we headed into the end of the year, these are concerns that might not get resolved overnight necessarily. This could be long-lasting.
Well, in the very beginning, we really thought it was going to be a short-term thing, a month, a couple of weeks maybe. Then there was big bets even here on the trading floor. There's no way that this could last this much. And then when it went to, 6 months, we thought, okay, this is going to be coming to an end. Now the real talk is that maybe it's going to go to the end of the administration. So there is real worries that this is going to continue. And, we were up against a lot of difficulties or challenges that we're going to be competing with Brazil in producing soybeans, just from the soybean standpoint, just producing that we were going to be competitive no matter what, even if we still had China, some China business. But without it and China moving completely to Brazil and us still holding the bag, it has been a challenge to farmers across the country. And I think that the difficulty that they have now is what do they do with their supplies? We did get a little bit of a run-up with the soybeans, but as we see the market start to pull back and this correction, starting to come, I think that a lot of the farmers are worried that they're going to, give up they're going to give up the small margin that they are trying to make, and I think that that's the biggest thing. Farming is a very difficult. I'd say this, that I haven't seen it more difficult for them in probably like 30 years.
Yeah, you mentioned at the top,
trying to decide what to do.
You mentioned at the top of the interview the extreme weather conditions that you've seen or that we had seen this year, the impact that it had. Let's talk a little bit about those worries and those concerns that you mentioned that you think will continue into next administration or potentially another 4 years with the Trump administration. Is some of the increased purchases that we heard about in terms of the negotiations process were being used sort of as a measure of good faith, but we were also hearing about they were a sign of just increased demand due to necessity in terms of Chinese needing these grain products and being unable to find them elsewhere.
Well, without a doubt, there is need from China. I think that they are resisting, so they've got their heels dug in. They're resisting buying anything from the U.S. because of, the challenges and the war that's going on right now. Also, the issue with the African swine fever, they've lost a huge portion of their herd, which means that their need for soybeans on one level is much less. Okay. We haven't talked at all about the effects that it would have on our pork market or cattle. That also is going to be affecting some of our grain markets as well. So everything is really tied in together. I think that we're totally hoping that that they're actually going to come in and take delivery. So some of the difficulty is they're this happens a lot around the world. Everyone comes in, they make commitments. We're going to purchase how many millions of metric tons of our grain. but do they really take the delivery? And once they take the delivery and the shipment, then we can really add that into the process of pricing out, what these values are for the futures. But I know that they've made some commitments, but really didn't take any delivery. So now everyone is kind of wringing their hands here, saying like, okay, you're telling us that you're going to do that, but no one's really moving the needle at all until they actually see some movement from the supplies, because we really have some big supplies across the board in corn, wheat, and soybeans.
Virginia, one more question on corn, because while beans were posting new highs for the year back in October with trade optimism tied to expectations we'd see a phase one deal between the U.S. and China, corn actually struggled into the end of the year. I think it was the August WASDE report we saw where corn gapped down, and it seemed it struggled to get back up above the $4 level. What was weighing on corn in 2019 mostly?
Well, it's really struggled to have any energy in the market. This fact that we are even able to breach the $4 mark at all is almost a miracle right here. But the weak demand is hurting us a lot. I mean, around the world, infrastructures are really improving, and it's making it more difficult for us. Yeah. Also, the U.S. dollar index is so strong, putting some pressure on these markets. And ethanol has had, weaker consumption, or, it's reduced to some of their consumption. And we're stuck with an awful lot of corn, despite the fact that we had difficulty getting this into the ground. I mean, we are a great production country, so our row crops, we can really produce a huge crop. The idea that anyone's talking about what's going to happen next year, that we could actually breach that billion bushel crop, would leave us with enormous stockpiles, and that can only be bearish on these markets. And I think that that's what's happening. But let me say this, the 370 mark is really a big benchmark and support level, including with open interest in the options right now. So we could see a little bit of a tail wagging the dog for the next couple of weeks for the December contract. But moving into next year, it's going to be very difficult to tell. And I expect that we're going to have a lot of volatility. It's seeing a big rally. I just don't see it coming unless there's some whopper of a number that we sign a deal that really brings in a lot of purchases from China and elsewhere.
You mentioned that the U.S. is a major producer here in terms of grains and some of the efficiency that we've been seeing. Really appreciate you joining us here to take a look at the grains. That was a great breakdown, a great discussion. Traders, that's Virginia McCarthy. She's the president of McCarthy Commodities, and thanks to all of our guests who helped us take a look back at the year in futures. That does it for the Futures Commodities Year in Review. Thanks for tuning into the TD Ameritrade Network. You can catch me on Futures with Ben Lichtenstein at 8 a.m. Eastern and Midday Movers at 2:30 p.m. weekdays on the TD Ameritrade Network. Have an awesome day, everyone.
What do you look for when you trade?
I want free access to research.
Yep, TD Ameritrade's got that.
Free access to every platform.
Yeah, that too.
I want to know what I'm paying up front.
Yes, absolutely.
Now offering 0 commissions on online trades.
To be ready for what's next, you gotta know what happened.
When I talk about the banks, I want to just hit it hard. The traders are betting no rate hike.
Join me, Oliver Rennick, as we take you through the final bell with the stories, trades, and charts behind the market action.
So rates are coming down. Did great because they were pinching pennies.
Exclusive content for cord-cutting investors, because no one does markets like we do.
Can't lie about cash flow.
Market on Close, weekdays 3 p.m. Eastern, 2 p.m. Central, only on the TD Ameritrade Network.
You've had quite the career.
I like working. What if my retirement plan is I don't want to retire?
Then let's not create a retirement plan. Let's create a plan for what's next.
I like that.
Get a plan that's right for you. TD Ameritrade.
I'm happy to give you the tour. I love doing it. Hey, Jay.
Jay? Charlotte.
Oh, hi.
He helped me set up my watch list.
Oh, he's terrific. Excellent tennis player.
Bye-bye. Africa. recognize that voice. Annie? Yeah. She helped me find the right bonds for my income strategy.
Very popular around here. There's a birthday going on.
Carl, he took care of my 401k rollover.
Wow, you call a lot.
Yeah, well, it's my money we're talking about here. Joining us for karaoke later?
I'd love to, but people get really emotional when I sing.
Help from a team that will exceed your expectations.
It's a beautiful piece of land, so why haven't you started building?
Tyler's off to college.
Yeah, and Mom's getting older.
And eventually we would like to retire.
TD Ameritrade can help you build a plan for today and tomorrow.
Come with a goal, leave with a plan. TD Ameritrade.